I wanted to thank everyone for joining us for this real client case study. Our initial case study will focus on tax mitigation using leveraged charitable strategies. Big mouthful, but addresses a very specific type of issue. Before we go into everything today, I'd like to introduce myself and then have our guest introduce himself. My name is Enpo too. I'm the Chief Operating Officer here at My Financial Coach, as well as a financial coach in my own right. A lot of the clients that we serve have a lot of W-2 income and some 1099 income. And one of the big challenges we have is finding ways above and beyond what their employer does for them. So with that being said, Lamar, would you be able to introduce yourself?
So my name is Lamar Breshears. I'm out of Salt Lake City, Utah. I'm the vice president of Harding Financial Partners. Been doing this since late 2007. And prior to that, I was an infantry officer in the Marine Corps and really just got tired of deploying multiple times to Iraq and Afghanistan repeatedly. So, I'm a financial advisor. I'm not a CPA, not a tax attorney. But my specialty is financial planning based tax mitigation strategies. So we're going to go over just a case study today and show you what we did for a W-2. It was a insurance executive, and his spouse is a doctor, a W-2 doctor for a hospital. This is just one strategy of several dozen that we have. But I think it's a good illustration of how we can positively affect your taxable income while helping out other people.
All right. Well, I want to set the stage for all of our listeners to get a sense of what My Financial Coach does for our clients and how subject matter experts such as Lamar work with My Financial Coach. As the people who have My Financial Coach already know, you get your own certified financial planner who is your personal fiduciary, who with a payment of a membership fee will always look at opportunities to help you improve your financial outcomes. So there are a wide variety of reasons why people come to My Financial Coach. Sometimes they have questions around their readiness for retirement. At times, there are questions about if they're taking full advantage of their employer benefits, which could be 401ks, it could be insurances that their employer provides for them, such as an HSA. But a lot of the time, they come to us because they're concerned that they are overpaying their taxes. And for a lot of our 1099 clients, there's a lot of strategies that they're able to implement with their CPA. And thinking about what a CPA might do if they walk in to a CPA office, they'll take a look at the 1099 income and say, okay, well, this is probably reasonable compensation. So this is your W-2 income and you paid this much on Social Security, but the rest you might take as distributions. And here's some of the expenses you can expense. Maybe if you have the ability to contribute to a 401k, hey, you can create one for yourself. So these are all good ideas that a tax person can bring to you if you're a 1099 individual. However, if you're a W-2 individual, a lot of the times when you go to a CPA, they'll say things along the lines of, well, do you have a mortgage? Do you have any rental properties? Are there things that you can do using income outside of your W-2 to help mitigate your taxes? But really, there are a limited set of deductions that you have as a W-2 individual. And so working alongside our client CPAs, we go over a few different ideas with them and thinking about the ideas that someone may bring to their CPA. That's where we have individuals such as Lamar and our subject matter expert program. We do not offer any direct tax mitigation solutions. Instead, we identify the issue, and the issue of high taxes with a W-2 is something that we run into time and time again, whether it is a very high income earning physician or someone who is a medical director, executive. all of these individuals tend to have similar issues. So today we'd like to bring a case study for everyone's consumption and attention. So we have an executive. These are real numbers, real clients. The names have been blurred out and changed so that you do not know who this person is, as well as a nurse manager spouse. Now, looking at their incomes, you will see that these are all W-2s split between bonuses and salaries. So they are in the high tax rates because their W-2, even with all of the 401k contributions that they can make, all the salary deferrals available, they are struggling to mitigate their taxes. And this has not necessarily kept them from increasing their net worth, but they want to know, hey, we have a little bit of time. We're relatively young. We're in our 40s. How can we save over our lifetime taxes? And I say over a lifetime because when an individual works with my financial coach, we're not just thinking about tax year 2023, 2024, or 2025. We're thinking from 26 all the way to age 90 plus. And we take a look at your current effective tax rates versus your future projected tax rates. And we see this a lot where a lot of our clients in their prime earning years will consistently have their effective tax rates above 25%. And then when they retire, because they've already paid off their mortgages, they've already sent their children to college, they don't have as much of an income need, their tax rate falls down until they hit the required minimum distribution age where they start taking their income back up. But the real question is, hey, how do we mitigate our taxes in these prime earning years if I'm not a 1099 individual and able to create my own 401k, potentially cash balance pension, or write off my business expenses? How do I do that? So what I'd like to do is share with you when our financial coach brought this issue to Lamar, how he thought through this and addressed this question, as well as what solution Lamar and the financial coach came up with. Lamar?
So just some background really quick on what this couple wanted. What they didn't want was to have to start a new business. They didn't want to have to manage like a rental property, which generates depreciation. They didn't want anything complicated. What they were looking for was, is there something we can do that's simple, effective, legal, and reduce the amount we pay in taxes? Because they were both super busy. Again, he's an exec of a insurance company, and she works in a hospital full time. So we presented this program. Now, I will say this, the program is still active. We actually have multiple providers for the same program, but the medical product differs year to year. All right. So for this year, and this was 2 years ago, the medical product was Novaderm. And I'll just give you some quick background on what Novaderm, the medical product, is. It's for skin grafts or large open wounds. So instead of taking a patch of skin off one part of the body and grafting it on, what they do is they take a small 1 square centimeter sample of skin, they grow the skin, and then use the patient's own skin to graft back on with the intent to reduce infection, reduce pain, reduce recovery. So they're just taking a small sample of skin and growing it. So that's the medical product. All right. So what this program does is it's run by a tax attorney firm out of Dallas, Texas. And then I've got another group that runs an identical program with a different medical product here in Utah. Both do in fact, they used to be the same group and they just didn't get along. So they both do the exact same thing. So what happens is, and I'll use myself as an example because I use this program personally. I come in as a client and I purchase LLC units. Each unit costs $10,000, and you can do a minimum of 5 units. So $50,000 is a minimum. Now, when my money goes into the LLC that I bought into as a client, our money is used to purchase the physical medical product. In this case, it was the Novaderm cell growth technology. So once the product is purchased, the LLC then signs a service agreement with the providing company, right? Because the technology is only good if you use it as part of a service to grow the skin, right? So the investors purchase the technology, a service agreement is signed, and then the LLC as a whole is donated to a nonprofit entity. Now, in this year, in 2023, there was 80 million of product, and each LLC has about $2.5 million in it. So there's multiple LLCs. So these LLCs were then donated to 501c3 entities. That included nonprofit hospitals, the Department of VA, and several veteran-based charities that were providing skin grafts for military burn victims from Iraq and Afghanistan. Now, once the LLC is donated to the nonprofit entity, a third-party valuation firm is brought in, and they conduct an evaluation of what is the value of the LLC with the medical technology plus the service to grow the skin. In this case, the valuation came in at a $5, meaning that the client put in $1, but the donation value of the LLC was $5. So from the client perspective, they bought into an LLC, and then the product plus the service inside the LLC was donated to a nonprofit. They put $1 in, they got a $5 K1 write-off against their ordinary income. So it's important to understand, though, that the valuation is done by a third-party group, a third-party firm. They do register that appraisal and that valuation with the IRS. And then the K1 that the client receives, that I receive, is based off of that valuation, but there's no guarantee on the valuation. I've been doing this for years. I've seen the valuation as low as like 4.2. I've seen it as high as 5.2, meaning that if you put $1 in, you get a 4.2 write-off or a $5.2 write-off. So the valuation is dependent on the third-party valuation team, and then they do register that with the IRS. So that's the process. The effect that it had on their overall taxes is when you make a donation deduction, you can write off up to 50% of your adjusted gross income per IRS regulations. So if you look on the right-hand side here, they purchased 5.9 units, $59,000 worth. And if you look at a comparison of the total taxes here, you can see that it took their taxes from 222 down to 116, which is a $105,000 tax savings, or 106 if you round. And that led to a net tax savings of about $47,000. And you can see what it did to their effective tax rate. Now, one of the questions that I get is, how complicated is this to implement? And it's actually pretty simple. You sign a purchase agreement, you wire your money for the purchase agreement, and in March, April next year, you receive a K1 that you give to your CPA. It's really, you could execute everything in 30 minutes if you wanted to. So just as a quick recap, what the client was looking for was something that was simple. They didn't want to have to purchase a rental home or heavy equipment. They wanted to keep it simple, effective, and have a positive impact on their W-2 taxation. So again, we provided this strategy, and we have other strategies as well, but we provided the strategy, and you can see the net effect that it had on our tax savings right here. So that's really this one case study. You can see that a very effective way to reduce your adjusted gross income for taxation purposes. And you're doing good for others, right? You're purchasing a medical product inside an LLC that will be donated to a nonprofit and will help people who either need the assistance because of their financial situation or their medical situation. So um, I'm going to open up the chat right here and we can answer some questions.
I'd like to maybe deep dive a little bit more. Uh, Along the way, a lot of people, when they are bringing anything up, I think the number one concern is, hey, will my CPA sign off on this?
Yeah.
And so thinking about Novoderm, what were some of the concerns that this client had or the CPA had? Could you maybe go into that a little bit?
Yeah. No, that's a great question. Thanks for bringing that up. What I'll say this about the CPAs. CPAs are provided with a tax advisor FAQ sheet that goes into pretty good detail about the program, how the valuations are done, how the value is achieved. And then additionally, we do have multiple tax attorneys that your CPA can talk to directly. I think in the past, 10 years or so, I've maybe had one or two CPAs who weren't comfortable, but I'd say 98, 99% of them, once they have a chance to talk to the attorney, the tax attorney, they understand, they read the FAQ, how it all works. Very rarely do we have a CPA who's just not comfortable with it, but they do exist. So first off, there are resources. Again, the CPA, when they have their technical detail questions, and they're not talking to Lamar, they're talking to a tax attorney that runs the program for that. So that's the first thing. What we're not showing you here are the private placement memorandums, the investor FAQ sheets, the tax advisor FAQ sheets, the tax opinions, that were written up by third-party tax attorney firms. So when it comes to supporting documentation to support the program, these programs do provide a full suite of tax opinions, resources to talk to for your CPA. So we do get a lot of initial skepticism, right? How do I put a dollar in and then get a higher write-off? Well, there's a process, and it's all done legally in accordance with the tax code. But those resources, written and in person, are available for your CPA to do research. So fully expect that. It's not unusual. It's not offensive to ask questions, right? We want everybody to be comfortable with the program and what they're doing. And what I always tell people as well is if you don't understand it or you're not comfortable with it, don't do it, right? So, Enpo, does that answer your question?
Yeah, and I think also clarifying further, right? If an individual CPA says, hey, I have to look into this and do due diligence and whatnot, I think what they are also wondering is, hey, how much extra work is this going to be? I mean, not to throw any aspersions, but a CPA, a lot of the times, our clients are very smart with their money. So they want to get a very reasonable service, tax filing at a very reasonable price, usually under $1,000. And so the amount of work that is increased by doing due diligence into some of these things, but then also maybe having to file additional documents. There's usually a question of, hey, do I get more money if I were to file additional K1s for my client? What exactly are some of those considerations as a CPA? If I am a CPA, what are some of the things going on in my head as you've been working with a few of them?
Yeah, so you're going to get different types of CPAs. Some CPAs will read the tax opinion, look at the supporting documents and get comfortable with it and not need to talk to anybody. Other CPAs won't even look at the documents and they just want to talk to someone. So that requires time to have a call with the tax attorney. In terms of actual work for a CPA, Very little, right? You're going to provide them a K1 and they're going to enter the K1 on your tax return. Like, just like, if you did a 401k contribution or you took a tax deduction for a business expense on a Schedule C or something like that. So in terms of the actual physical work for the CPA, little to none. If the CPA does work, it's because they're doing the due diligence. And again, the goal is to provide them with both written and live resources so they can do their due diligence. They don't have to do due diligence in a vacuum doing Google searches. Right? We can provide citations, tax opinions, everything.
So that's all well and good. I think a lot of CPAs, they're just worried of the audit risks of any strategy that they do. So what have you seen? Have there been any challenges? If there have been, what have been the results?
Not at the individual level, at our level. If there is going to be an audit, it's going to be an audit of the valuation of the LLC that was donated. And that's why it's important to have a third-party appraiser. And then that third-party appraiser, like any appraisal that's looked at by the IRS, will have to justify how they achieved that valuation. I know for a fact that they always err on the side of caution when it comes to the valuations. And the valuations are not hard because there is a retail price that hospitals and the public purchase the medical product plus the service. And that forms the basis of the valuation. They're going to do a conservative valuation based on the retail price that hospitals pay or a charitable organization would pay anyways. So I've only seen in the past 8 years, I've seen one examination of the IRS for actually with Cirrus Investments. And that's what they looked at. They said, okay, the members of the LLCs received K1s. They took this deduction. We want to see how you arrived at the valuation for that medical product and service. And once those documents were provided, they had a no change from the IRS. So I've never actually seen an audit of an individual. Everything's been at the institutional level, at the Cirrus investment level. And then it's been focused on specifically how the valuation was achieved. But I've only seen that happen once in 8 years. So
now, as a CPA who is filing taxes for my clients, or maybe just a tax filer, tax preparer, whatever I am, if I were to sign off on this strategy, what are the physical steps? I mean, if I am a CPA who's never done this before, what are my jobs? I mean, give me a timeline. So let's say in this specific case, wind the clock back to 2023. What did this tax preparer filer have to do?
Yeah, so from a tax preparer's perspective, you emailed them a K1 and they entered it on your 1040. That's it. Like,
but give me a timeline. What dates? What times?
So
the client brings this
you're going to
over to
receive. I know what you're getting at. So thanks for bringing that up. One of the things that we don't control is the timeline that it takes to do the valuation. And it's not a small process, right? Those donation valuation experts, it takes 3 to 4 months on average, and that doesn't start until early January. So one of the things that we highly recommend, and when I say we, I'm referring to tax attorneys that run the program, is that you file a tax extension on your personal tax return, because there's no guarantee that you will have a K1 by April 15th. It's only happened one time. Like I said, in the past 8 years that I've been doing this, but it has happened, right? So from a timeline perspective, it's highly recommended that you file an extension on your personal tax return. But typically, the K1s, they come out at the end of March, early April, in time for your April 15th tax deadline. But again, there's always that one-off, and that one-off was actually 2023. What happened was the appraisal specialist came down with cancer, went into chemo treatments, didn't tell anyone, and he went dark for like 6 weeks, and so they had to find a different appraiser, and then start the process all over again. So we actually didn't get the K1s till June that year. But like last year, 2024, different product, same program, different product. Had everything out by the third week of March. So and I think, Enpo, that's what you're getting at, is file the tax extension to be safe and let your CPA know why, which is you're waiting on a K1, but that K1 is dependent on the donation evaluation expert to produce what's called a Form 8283 with an appraisal attached to it.
So just to beat a dead horse, because I just want any CPA who is listening to this call to know this is kind of what I would be looking at. Wind the clock back to 2023. If I was looking at this for a client, my client will bring this idea to me, let's say sometime in September. I will do my due diligence. It might take me a few weeks. Okay, so let's fast forward the clock now. It's time for the client to make these contributions. Okay, that's great. I will now go in and say, okay, well, we're now moving into the next tax year. It's 2024. I'm still gathering documents. My client's W-2s have started to come in. Their 1099s have started to come in. I'm going to ask, hey, have you received the K1 yet? Have you received the K1 yet? Okay, it's starting to now get closer to April. It's March. Okay, now I have to go, okay, I can understand this might take a little while longer. Let me file an extension. So based on that extension, I still have to pay my estimated taxes or whatnot. But because I have a W-2, my employer's been doing that for me. If I have a 1099, I might not have to pay as much because I'm expecting a refund in the future. But let's say it's all W-2. I just file that extension. And then sometime, let's say in June, when I get that K1 or whatever I get from the company, then I will file taxes. And now we're waiting for that tax refund back to the client. And the IRS will process those however long it takes. And if your state has a state income tax, you will also do that. Is that correct?
That's correct.
The whole timeline. Is there anything in that timeline that was missed, perhaps?
No, you have it down. One other thing I'd like to bring up, Enpo, I always get this question. And for those of you, you see me like kind of moving my head around. I've got this light beam coming down right there. So I'm kind of moving to the side, trying to stay out of it. The compensation, I always get the question, how am I compensated? I get paid a referral fee by the company that provides the program. So I don't send you an extra invoice, or if you pay into the program, that's what you pay. I do get paid a referral fee out of that from the provider of the program. So I thought I'd just bring that up. So people are, I'm going to get in. You're not going to get an invoice from me or an additional invoice from me or my financial coach. So there's a question in chat. I'm just going to do it right now. Isn't the tax preparer's job to report the tax info on the return? They just put the K1 on the return. In other words, the strategy doesn't really need the preparer's blessing. Yes, but the preparer, if they're not comfortable with it, can also refuse to sign the tax return. So yeah, we don't necessarily need the preparer's blessing, but you want them to be on board because they won't sign the tax return if they're not comfortable with it, right? So the answer is yes, that's correct. But the reality is we want to make sure that we provide the resources for them to do their due diligence so that they'll sign the tax return. So.
All right, well, we have one additional question. What is the competency or the expertise of the third-party appraiser? Because it's all well and good if you have legal opinions and tax preparation, but this third-party appraiser, I mean, how skillful are they? And will it ever be questionable if they are ever
Yeah, so a third-party appraiser that does donation valuation specifically, typically they're going to be in a state valuation firm. So I've got one right next door to my office here. They don't do these specifically, but they do, like if you donate a property to a nonprofit, or if you donate a portion of your estate at death to a nonprofit. They're primarily an estate donation valuation. There's a number of licenses they have to receive, and also realize when they do that valuation, they're putting those licenses and their errors and omission insurance on the line. So what you're not going to get, you're not going to get a rubber stamp where somebody says, hey, we want this to be this value. They are going to be working as an independent third party because their insurance is on the line, their valuation. And if there's an audit, they know that they're the ones being audited in this situation with the IRS. So in terms of the specific third-party appraiser, there's numerous third-party appraisers that these companies use. Keep in mind, I have more than one provider. And again, but it's going to be a firm that will do donation valuations plus estate valuations. The guys next door to me have 40 years of experience and they're nearing retirement, but yeah, it is going to be a licensed third-party valuation expert, and there is a process that they go through to arrive at that valuation.
So I think that's a good point, that these are professionals. It's not like you're walking to Goodwill and the Goodwill employee hands you the slip and they go, okay, take an estimate of how much you've donated. That's not what's going on here, right?
Yeah, they're looking at market rates. They're looking at, sales history going back years to generate what the actual defendable value of that LLC is. Yeah, I think most people will be surprised at how in depth and how long it takes and how expensive it is to do one of those. So,
all right. Well, I want to thank everyone for joining us today. This is the first in our series of showing how my financial coach is able to identify our client pain points. And working with subject matter experts such as Lamar, we are able to get to better financial outcomes. And in this specific case, it was to help an individual realize lower taxes, not just in this tax year, but the expectation is these are one-off solutions, but they do come around often enough where this could be an annual solution. And over the lifetime of a client's interaction with my financial coach and subject matter experts, we hope to look at innovative ways to decrease these effective income tax rates. Thank you, everyone, for joining us, and we look forward to getting a copy of this recording out to everyone, and hope everyone has a wonderful rest of their day.